Hey, good morning, trading fam. So, in this week's video, I'm going to take a look at our housing market chart. A couple of years ago, I believe I created a video on this chart warning us that it was showing signs of a weakening economy. In this week's video, I want to revisit that chart. I believe I had posted several references to this chart in various static posts since that original video, but now it's time to revisit because I think it's showing us something very critical we'll want to take a look at, and it's giving us warnings that we want to pay attention to. Of course, the number one thing that U.S. Consumers are after in the economy is a house. It's going to be for most Americans, the largest purchase, the largest investment they make. And so, when the housing market starts to weaken, it's really time for us to take note of that, as it is showing signs that the U.S. economy may follow in. Its footsteps. So, for that reason, I want to take a closer look today at our housing market chart. All right, guys. So here's my chart. This chart is based upon the United States NAHB Housing Market Index right up here. All right, so that's what we're going to be tracking. And I want you to follow the purple arrow for the purposes of this video because I'm going to be focusing on various different drawings, indicators, and trend lines. I know the chart is noisy. There's a lot of data in here, but it's all important. So follow that purple arrow as I speak on the various different things. The first thing I want you to notice here is the Dow Jones Industrial Average that is indicated by this purple trend line. All right. Now, recently I've been following the S&P 500, but if I put that index up here, it kind of scrambles all of my drawings. So the Dow Jones Industrial Average is serves the purpose here and lets us know what the U.S. stock market is tending to do. All right. And then you'll see the Fed rates with the gray dashed line here. All right. This is what the Fed does in terms of lowering interest rates, raising interest rates, et cetera, et cetera. Of course, the red and the green is the NAHB Housing Market Index line. We'll talk a little bit about this, but we're going to, and then down here, guys, is the RSI on a monthly basis. This is also important, and we'll reference this from time to time during the course of this video. All right. So what I want to discuss first is the housing crisis in 2006 to 2009. I want you to notice here the housing market was, hot, really, up here before the crash. Some people knew the crash was coming. I was one of them because I paid attention to people who knew what they were talking about, and not the talking heads on CNBC, but the people who were warning us a housing market crash is coming. All right. So what happened here? The housing market started to crumble. Let's see, what was the date here that we peaked? 2006, June of 2006, and it started to show signs of falling from here, and then it entered this weakening demand zone. This is a zone that I've drawn up and talked about in the past. When we drop below that, that's a serious flag for us to pay attention to. Of course, when the housing market drops, the number one commodity purchase, that investment that U.S. Consumers are after, that is a sure sign that the economy is going to follow. And so what happened here is we fell below this weakening demand zone, and that should have been our first sign that we are going to enter a recession. But of course, if you look at what happened to the Dow Jones Industrial Average, it continued to rise. All right, retailers were continuing to pile in. And I say retailers, it wasn't necessarily insiders or big investors. It was retailers that continued to drive this market higher. And you can see here that about 2 months after the housing market dropped below this weakening demand zone, that the Fed began to pause rates. You see this flat line here, that's the Fed rate. That is their pause. And you can see up here, I have indicated that it wasn't until 14 months after the housing market demand fell below that weakening demand zone that the Fed began to ease rates. Right here, it began to ease rates. All the while, the Dow Jones Industrial Average continued to go higher and higher and higher. In fact, it wasn't 17 months until after the housing market entered this weakening demand zone and fell below it, that the Dow Jones Industrial Average topped, or the U.S. stock market topped. All right, so pay attention to that because that is similar to what is happening today. And then once the housing market fell and bottomed, that is when the Dow Jones Industrial Average began to pay attention and fell and bottomed nearly the same time little bit after. I think the housing market had bottomed about a month before. Yeah, it looks like about a month before the Dow Jones Industrial Average bottomed and created this V-shaped recovery. All right. So let's just talk about the RSI a little bit too. The RSI is important too because it shows us where the beginning of the crash began. Uh, when the housing market dropped below, basically, it says 26 on the chart. That is a good area. That was the beginning of our housing market crash. All right. And when the RSI moved above 26, that is when up here on our housing market chart, we were showing signs of stabilization in the housing market right here. And then on the RSI, I have another line here that's at 49. When we move back above that 49, basically mid-level there on the RSI, you could see the housing market begin to strengthen once again, all the way up and through the weakening demand zone. So pay attention to that as well, because fast forward to today, the housing market really, there has been this inverse correlation on the RSI. In other words, the RSI topped here in, when was that? 2012. And ever since then, it has been on the decline. All the while, up in the top part of our chart, getting out an arrow here again, the housing market prices and the housing market demand continued to increase. That inverse correlation there is a very telltale sign of what is to come to continue to occur in the housing market. All right, so back in August of 2022, we fell below this 26 on the RSI again. That was important. That's a telltale sign that the housing market is going to continue to decrease. And definitely on the RSI, it's indicating continued weakness in the housing market. So now we're going to jump back up to the top portion of the chart here. You can see when we fell, COVID excluded. That doesn't count. That data is happened very quickly. When the housing market actually started to fall below this weakening demand zone again, you can see it correlates with us falling below that 26 on the RSI in that RSI chart below. All right, so the housing market is continuing to experience weakness. We have a triangle here, a bearish triangle, which we have more recently dropped below, came back up to test the bottom of that. As we do, all good technical analysis know that's a common occurrence, coming back up to test important resistance. And look at this, guys. Look at what the Fed's doing and what the Dow is doing in correlation. All right, the Dow is continuing to rise exponentially as the housing market weakens. The Fed again is delayed in their pause. And let's just go ahead and read the box here. All right, in 2006, it took the Fed 2 months to pause and another 12 months to ease from this intersection. What intersection? The intersection here when we fell below the weakening demand zone. All right. But in 2023, it took 5 months. All right. And you can see right here, we fell below the weakening demand zone. We entered that. It was a full 5 months before the Fed started pausing from that intersection. That is 2.5 times as long to pause. The Dow Jones Industrial Average topped 17 months after this pause over here in 2006. All right. Now we're going to take that 17 months and multiply it times 2.5, which is how much longer it took the Fed to delay before they paused. And that equals 42.5 months from this intersection right here. All right. So I have another line drawn right here in the dashed. This is the estimated top for the Dow Jones Industrial Average. That is 42.5 months from this intersection right here, guys. All right. So that puts us at a top in April of 2026. It is mid March right now. I believe this chart is spot on. Housing market will continue to deteriorate. And guys, I think I had 3 targets drawn on the SPY. You guys all know and have followed that. We hit all 3 of those targets. Now, I know people like David the Contrarian is calling for a higher top. I'm not so sure about that, guys, based upon this housing market chart. This housing market chart is telling me that the Dow Jones Industrial Average and the U.S. stock market has, in fact, topped. And of course, with the recent war in Iran, all the chaos and all the geopolitical bullshit that's going on, basically, it's just causing more and more market uncertainty. Oil Prices are spiking. I have oil over here actually, $100 a barrel. I'm betting here, guys, that this is the top in the U.S. stock market, and we're going to continue to experience um, decline in the U.S. economy. And I don't want to talk about the D word, but this is at least going to get into a recession, and it's going to start here in March and April of this year. All right, guys, so I don't want to be a doomsdayer. The whole purpose of this video is really just to warn you about what I see coming to help you navigate this market, take proper precautions, protect your capital, and trade accordingly. If you enjoyed the video, y'all know what to do. Until the next one, peace, y'all.